We're going to get more into the heart of the MixMax case today in this recording. A couple of things before we actually get into January's case that I want to go over. So I just got a couple of points I want to lecture about. One happens to be with cash flow categories. So I kind of want to go over that. You know, usually if we start up a company, we can finance with debt and equity. So we might borrow money or issue common stock or preferred stock, and that'll raise some cash. So whether we're just needing a big chunk of change to expand or we're starting up, either way we finance with debt and equity. So then money will come in, and we will take that money and invest in our long-term assets. So we buy equipment. If we had, let's just say we had a lawnmower, we mow yards. That's our business. So we would be buying lawnmowers, maybe a pickup truck or a trailer to haul that all around. So then we take our lawnmowers, and those are going to generate revenue for us, right? Because we're going to mow yards, and if we mow yards, we're earning revenue. Okay, so then our assets are used to generate revenue, and our revenue ultimately, hopefully, results in net income, profits. And I shouldn't overlook, but you know, we do have the revenue, and of course, in the midst of all of that, we're going to incur expenses. And the outcome, hopefully, is net income. And if we have net income, that should satisfy our investors and creditors. So that's just a real basic business model, right? We borrow money or we sell stock to raise cash. We invest that cash in our long-term assets. Our long-term assets are used to generate revenue. From our revenue, we also incur expenses generating that revenue, with hopefully the outcome is profits. Profits satisfy our investors and creditors. So then we have these three business categories. And the three business categories on both the international accounting standards and now the cash flow standards in the United States break it out into the three categories. So we have our financing activities. So we finance. So our financing activities have to do with debt and equity. And then we have investing activities. Investing activities center around the long-term assets. So we have financing, investing, and then the main core, though, of what we do, right, are incurring these expenses and generating revenue. This is all our operations. So our operating activities. So those are our three cash flow categories: financing, investing, and operating. So any cash flow, cash coming in or cash going out for it is long-term debt. With long-term debt and equity is financing. Any cash coming in or out that pertains to long-term assets is investing activity. And then any cash flow coming in from revenues or cash flows paid out for expenses, those are all operating activities. So just a review of that. Okay, the other thing I want to just kind of give you a little review is just a reminder, you know, the balance sheet is a snapshot. It's at a point in time. So we might have our beginning balance sheet, I'll just abbreviate that, at the beginning of the period, and then another snapshot of that balance sheet at the end of the accounting period. So beginning and ending balance sheet. Now, typically, the annual report reports 2 years for a balance sheet. Now, what happened to that balance sheet gets conveyed in two financial statements. One financial statement that conveys, you know, really the story of what happened to the assets, liabilities, and stockholders' equity from the beginning to the end. The income statement conveys some of that information. So get some of that there. And then the statement of cash flow also conveys some of that information. So here's what's going to happen as we move forward in MixMax. There are 4 items here in this scenario. And what's going to happen is we're going to be given 3 and we'll solve for the 4th unknown. Well, if you take a peek ahead at January's MixMax case, we're going to be given the beginning balance sheet and the ending balance sheet for January. And then we're going to be given the cash flow statement. And by knowing those three, we'll be able to problem solve for the income statement. So here's going to be our process. Step number one, we're going to solve for the changes in the balance sheet accounts. So we're going to go account by account all the way through the balance sheet, and we're going to quantitatively solve for each of those. Did they go up or down, and what was the quantitative amount? Number two, we're going to factor in these cash flow transactions. So we're going to have a spreadsheet or worksheet that we will journalize the impact of the cash flow statement. So we're going to put that into the T accounts. And then third, we're going to discover the only thing left in our T accounts are income statement items, revenue and expenses. So we will be able to derive our income statement transactions. Because that's all that's going to be left in those accounts. Will be revenues and expenses, and gains and losses at times. Okay? So that's our process. Okay, so let's move forward. Okay, so here's our January mix. So here's our assets, beginning and ending balances. Here's our liabilities and stockholders' equity, beginning and ending. So what we want to be able to do is look at, how did it change? So I'm going to take the ending, subtract the beginning, and I'll get these dollar amounts. I don't want dollar signs on all of those. Okay, that's a little bit easier to read. Okay, so here are our changes. And we can even see, you know what, I'm going to make sure, let's do auto sum. I'm going to sum this. I'm going to sum this. And I get 55,425. Okay, so I netted this amount. I got 55,425, and that's the same as when I took the difference here. And let's do the same over here. Let's sum. I'll do it, key it in this time so you can see it. And sum all of that. So I've got F7, so column F, start at 17, F17 through F25. Close my parentheses and hit enter. And I get 55,425. So we're in balance. I had cross-footed, and it nets the same, and I put it regularly, and I get the same number. Okay, so now we have these differences. And we're going to go enter those into our T accounts. So let's go to January T accounts. Okay, so we'll start with cash. Cash went up, $2,600. So I'm going to put that on this side, on the upside. Accounts receivable also went up. So I'm going to put my $6,000. So these accounts are a little different, aren't they? They're called double T accounts. So in the double portion, I'm going to put the change, the balance sheet change. So cash went up to $2,600. I'm going to put that change, the dollar amount that it changed in this column, in this row. Inventory went up $3,000, so I'm going to put that there. Prepaid rent, though, went down, so that would be a credit. Property, plant, and equipment went up $45,000. And we had a change in depreciation, $675. Let's go back and look at depreciation. Now, one thing we're going to have to remember with depreciation, it's a contra asset. So even though I have a negative here in the difference, it does reduce total assets. So, this is really the impact on total assets. It's going to cause it to go down. But because it's a contra asset, that account went from 0 to 675. This is really a credit. So the account really went up, right? So, so the account actually went up, and of course its changes on the credit side. Okay, the other ones, interest payable went up for 50. Unearned revenue. Interest payable, let's look at it. Interest payable went up $450. Unearned revenue went down $1,400. There are two accounts payable accounts, one for merchandise and one for services, and those both went up. Let's put those in on the credit side. Current portion of debt went up, so did long-term debt and taxes payable. So that's the assets and liabilities over here in equity. Retained earnings went up, and nothing happened with common stock. Okay, so we can look at, let's take a peek at the cash flow statement. So we have a collection from credit customers. Well, what would the journal entry have been when that happened? So, this in green, this will show. So cash would have come in, $20,500. And then we also would have had a credit. Now this is from credit customers, so we've already made the sale. So since we've already made the sale, this is a collection of accounts receivable. Follow, the sale already took place. This is just recording the collection of the account. So cash collected from credit customers would look like this. So let's go put this entry over on our spreadsheet. Okay, so we would have, let's see, what was that, $20,500 coming in, and accounts receivable would have gone down $20,500. I'll make that in green. And, you know, I can't really do this on Excel very easily, but ideally you would be labeling these like, you know, number 1 and number 1. So transaction 1, debit cash, credit accounts receivable. Let's do the number 2, advances from customers. So again, cash is coming in, $2,900. And that would go in the unearned revenue account, right? Because we owe good, cash came in, and we owe goods and services, so liability account. Okay, so we're going to go journalize the impact of this in our T accounts. So number 2, 2,900, and then over here in unearned revenue, it will go up 2,900. Transaction 2. So we have a debit to cash, 2,900, and a credit to unearned revenue. Next is a cash payment. Cash paid to suppliers of merchandise. So cash would be a credit, $16,500. $16,500. And then our debit, this is not buying merchandise, this is the payment. So the original transaction would have been buying the merchandise and then owing money. This is the cash going out, and now we get to reduce our accounts payable. And again, there are 2 payable accounts, so we're going to be very specific. This is the accounts payable for merchandise. Okay, so accounts payable merchandise goes down, cash goes down. Let's go put that in IT accounts. So 16,500. Move that, make it green. So we got a cash transaction in green, and then accounts payable merchandise, cash going down. Ready? Okay, and then our very last one, cash payment for utilities and wages, so those services. So the typical services we would be paying for would be wages and utilities. And again, this isn't buying those or using those. This is now the payment for those. So accounts payable, services would be our debit. Because again, assume we've already accrued this as a liability, and now the cash is going out. and we assume that we've already accrued the wage expense. Now we're paying it. Okay, let's go put this into account. Okay, so we've done step 1 is in black. That's the changes in the balance sheet. Step 2 has been factoring in the impact of the income statement. So we still want to figure out, well, what's going on with these accounts? So if you take what's in green under cash, take the debits minus the credits, we'll get this total change of $2,600 in the account. And we want to figure out the same for all these other accounts. For instance, we know accounts receivable went up. It went up $6,000. Well, what caused it to go up? We know that we paid out we collected $20,500 for that account. So here's where you really have to understand what are the ins and outs of these accounts. So let's think about, well, what is a transaction that caused revenue to go up? Accounts receivable to go up. Well, revenue does. Selling revenue on account causes it to go up. And cash collected, right, is going to cause it to go down. Those are the main transactions in and out of the cash account. That can change over time, but generally speaking, that is our ins and outs for that particular account. Okay, so that means if the account went up, revenue must have exceeded the cash collections by $6,000. So if that's the case, and we put revenue in blue here, then revenue must have been $26,500, right? $26,500 minus $20,500 give us this overall increase of $26,500. Okay, so we just solved for revenue. So let's go over here to our income statement and set up a revenue, well, maybe sales revenue account. Okay, and I'm going to post my $26,500 in that. Okay, so we just solved for a journal entry for the revenue. Debit accounts receivable, credit sales revenue. So now, now we're going to, the last thing left in all of these accounts are either going to be a revenue or expense for the most part. So we just solved for sales revenue through the accounts receivable, and we made the journal entry. The journal entry would have been a debit to accounts receivable, a credit to revenue. Likewise over here on unearned revenue, it's got the same sort of thing going on. It's going to go up when cash is collected, and it goes down, right? It goes up because cash is collected, and we owe goods and services. So cash comes in, that's the debit, and we credit unearned revenue because we owe goods and services. And it goes down because we provide the goods and services, revenue is earned. So unearned revenue goes up when cash is collected, and it goes down when we earn the revenue. Well, if unearned revenue went down, which it did, $1,400, that's because revenue exceeded the cash collected. So now I got to figure out revenue had to exceed this by $1,400. So revenue is $4,300 coming out of the unearned revenue account. So $4,300 minus $2,900 gives us an overall decrease of $1,400. So we just have another journal entry now to sales revenue. Sales revenue, $4,300. So this journal entry would have been a debit to unearned revenue and a credit to service revenue. And now these accounts receivable and unearned revenue are in balance. And by the way, you may have noticed already, notice the crisscrosses balance. 14 and 2,900 equals this 4,300 and 0. 6,000 and 20,500 equals this 26,500 and 0. So the crisscrosses in these double T accounts will always balance. All right? Okay, well, let's look at the inventory account. Inventory goes up because we purchase goods, and it goes down because we sell them, and we decrease And we're going to decrease inventory for the cost of the goods that were sold. Cost of goods sold. But we don't know either one of those. So we're kind of, stuck. We kind of hit a dead end. Well, let's go over here to accounts payable merchandise and see if that will help us figure this out. Accounts payable merchandise goes up when we purchase goods and we owe money for it. So it's going to go up because we purchase goods and we owe money for it. And it will go down, like all payables, it will go down because cash is paid. So there's three things going on. Accounts payable went up $2,300. That means purchases exceeded the cash payments by $2,300. So our purchases had to have been then $18,800. So we just solved for purchases of inventory. If that's purchases of inventory, then let's go over to the inventory account and record the related debit. Oops, didn't get that in right. 18,800. There we go. So purchases would be a debit to inventory and a credit to accounts payable merchandise. So again, we solve for the purchase out of accounts payable, then we can figure out, well, what was the credit? What was the debit? The debit had to have been to inventory. So we have a debit to inventory and a credit to merchandise. Now once we know that, let's go back to inventory. Now we know two of three things we can solve for cost of goods sold. If inventory went up $3,000, that's because purchases exceeded cost of goods sold. So cost of goods sold must be $15,800. Cost of goods sold is an expense. Let's go over here, set up a cost of goods sold account, and put our $15,800 in there. So we have a debit to cost of goods sold, $15,800, and a credit to inventory, $15,800. And if I could easily enough do this, all these entries in blue, I would probably label entry A, entry B, entry C, just to document that, but it's a little hard with Excel to do that. Okay, so again, notice our crisscrosses are equaling. Same thing with accounts payable merchandise. Crisscrosses are in balance. So let's just keep going along with this. Keep just problem solving and figuring out. We can figure out some income statement items. Prepaid rent goes up because cash is paid in advance, right? So it goes up because cash is paid in advance for rent. And so cash goes out, prepaid rent comes in as an asset, and when we use the rent, it causes it to go down. So it's going to go down for rent expense. If we use prepaid rent, or we use the rent, that's rent expense. Okay, the account didn't go up. If the account had gone up, we would have seen that on the cash flow statement, right? If they had paid cash, we would have seen that on the cash flow statement, but we didn't see that. So that means this whole $500 is due to rent expense. Again, keep in mind the crisscrosses have to equal. Rent expense is what caused prepaid rent to go down $500. Okay, so we just solved for another income statement item, rent expense. So let's set up our account over here and put in our $500. So we have a debit to rent expense and a credit to prepaid rent for $500 in blue. Let's do accounts payable services. Accounts payable services goes up because we owe money because of services. I think I'm just going to categorize that as operating expense. So we use wages and utilities. Those are our operating expenses. And like all payables, it will go down when cash is paid. Okay, so we know the account went up. That's because operating expenses exceeded the cash payment by $1,075. So our operating expenses must have been 4,100. I just caught myself, and you probably already saw this error. I am very sorry. I hate it when I do this. You may have caught that earlier. No, I didn't. Notice I had two credits, didn't I? Let's go back to this payment. We had a debit to accounts payable services and a credit to cash. And I got sloppy and didn't catch my messiness. Let's just review that again. We had a debit to accounts payable services, $4,300, and a credit to cash. You may have caught my mistake when I did it. If so, good for you. I'm just now discovering it, but again, so that debit and that credit. So now, that seemed odd to me that I already knew this number. So let's add these two together. That means operating expenses exceeded the other exceeded the cash payment by $1,075. So that means then our accounts payable services must be, it's not right, I'm not getting the right shade of blue. So this must be $53.75. So I'm going to go ahead and put the $53.75 over here in blue, and let's head up the account operating expenses. Okay, so we have a debit to operating expenses and a credit to accounts payable services. Property, plant, and equipment went up. Well, what's causing that to happen? Well, property, plant, and equipment will go up when we buy it, right? So it's going to go up when we purchase it, and it's really going to go down then when we sell it. If we sell or dispose of it. Sell, we get rid of it anyhow. So we must have purchased equipment. Now here's the puzzling thing. There's nothing green in here. So there's been no cash payment for this property, plant, and equipment. So then how did they pay for it? Well, they didn't pay for it with cash. How did they pay for it? Well, then I have to stop and think, well, they might have issued stock, but no, if they issued common stock account didn't even change. So they didn't sell stock. Well, maybe they issued debt. Well, here's a couple of suspicious accounts right here. Current portion of debt and long-term debt. Now, if you take the 38,627 and add the 6373 to that, let's do that real quick. And if I add those up real quick, sum those, I'll get $45,000. And that's not coincidental. That tells me they bought property, plant, and equipment of $45,000 and they signed a loan at the bank to do that. Now, here's the clincher. The current portion of that $45,000 is $6,373. So if let's say it's a 5-year note at the bank, they have to pay $63.73 within 1 year. Then the other $38,627 is due in the long run. That's going to be due year 2 through 5. So this is going to be due year 2 through 5. And this is due in the first year. So if this is a 5-year note, again, so if this is the year, set this up a little bit, then in the first year, the $63.73 is due, and then over year 2, 3, 4, and 5, they'll pay the remaining $38,627. Okay, so that tells me then they bought property, plant, and equipment. I'm not going to put it in green, I'm going to put it in blue, and they issued debt. So those are going to be my credits. Let's put those in blue. Okay, so here we go. We have a debit of $45,000, and we have 2 credits. Correct that one. There's 2 credits total $45,000. Okay, so we're in balance. So let's write a little description. The debt goes up when we borrow money, and of course it's going to go down when cash is paid. So these 2 liability accounts go up when we borrow, and they go down when cash is paid. All right, we did actually fine. So there was no revenue or expense coming out of that, was there? So this is an interesting one. The purchasing the property, plant, and equipment, that's actually an investing activity. Whereas over here, issuing the debt is a financing activity. If we take that back to this category, remember, if we issue debt and equity, that's financing. When we buy those long-term assets, that's an investing category. Okay, so this was financing, these two, this was investing, these two were financing. Okay, accumulated depreciation, well, what causes it to go up? It's going to go up because of depreciation expense. And it'll go down when we sell or dispose of the long-term asset. There was no disposal, so no cash came in. So depreciation expense must have been the change. So if the account went up, it's because of depreciation expense. So let's go add a depreciation expense account over here in the income statement area that are $675. So we saw for we would have a debit to depreciation expense and a credit to accumulated depreciation. Taxes payable. Well, what's going on with it? Taxes payable goes up because we owe money for tax expense. And taxes payable goes down because cash is paid. No cash was paid, or we would have seen it on the cash flow statement. So the account went up. On the balance sheet, it went up. And the only thing that happened to that account was we incurred tax expense and we owe money for it then. Okay, so we just saw for our income statement item, the income tax expense. And we'll enter in our $3,200. So we would have a debit to income tax expense and a credit to taxes payable. Last one over here is our interest payable. Interest payable, we owe money because of interest expense. And it's going to go down because we pay it, right? There must not have been any cash payment this month, or we would have seen it on the cash flow statement. So the account went up because of interest expense. So now we know it went up because of interest expense. Let's go, that's our last income statement account, interest expense. $450. Okay, we just saw for our income statement. Might draw a line here. Add up sales revenue. So if I were to write out an income statement, here's my sales revenue, here's cost of goods sold, and then it's all for gross profit. Under operating expenses, I have rent and operating, depreciation. Arrive at operating income. Our other items would be this interest expense, arrive at income before taxes. Here's our income tax expense, and then we would have our net income. So we could write it out. I'm going to bypass that just to save some time. Okay, so we have solved for all the changes in the liability and asset accounts. Well, let's go over here. We have retained earnings. Well, let's think about, we need to figure out, well, what caused that change? Well, what causes retained earnings to go up? Well, it goes up for net income, and it's going to go down either for a net loss or dividends. All right, well, if we wrote out our income statement, I'm going to tell you net income does happen to be $4,800, and let's figure that out. Well, how do we get net income into the retained earnings account? Well, if you recall from Chapter 3, it's going to go in there because we close out, right? MixMax would have closed out all of its revenue expense accounts. So it would have debited revenue to zero that out. It would have credited cost of goods sold, right? And once I credited that, the balance is going to be zero after this. So go down and just zero out all your expense accounts. Okay, so if I look at this last journal entry that I have in red, I have a debit of $30,800, and then I have all of these credits. if I take the difference between this debit and all of these credits, I'm going to arrive at $4,800, by the way. And it also represents net income, right? Because I'm taking revenue minus all these expenses, and I need another credit to balance. I'm going to be out of balance, and that's net income. So again, that debit, $30,800, if I add up all these credits, I'm still short $4,800. I need another credit to balance, and I'm going to take it to retained earnings for net income. And now we are finished. Okay, we have problem solved for all the changes in the balance sheet accounts, and by doing that in blue now we have our income statement. Okay? All right, there is that. On the next video, you might want to watch the February one. I'll set that up for you. Actually, hang on just a sec. Let me go ahead and do that. I know this isn't February, but I just don't have that open right now to look at it real quick. But if you will, turn to your February MixMax. What's going to happen, by the way, I hope you notice a couple of things. This January 31st balance sheet is going to be your February 1 balance sheet. So that's going to be something nice as we go forward. The other thing in February is that you'll have beginning and ending balance sheet, just like we have here. But what will be different is instead of a cash flow statement, you will have an income statement. So what that means for you is where I had us do 1, 2, and 3, we saw for the changes in the balance sheet, we journalized the impact of the cash flow going forward for you. Instead of the impact of the cash flow, you're going to journalize the income statement. In step number 3, you will derive your cash flow transactions. So so for February, you'll know beginning and ending balance sheet, and you'll know the income statement. You're going to solve for, derive the cash flow statement. So step 1 is the same, but step 2, you'll have the income statement, and so what will be unknown in the T accounts will be the cash flow. So again, and if you get confused, if you forget, well, what's a journal entry for sales? Well, we have 2 journal entries for sales, and you can come back to your work here and help you solve for. Or maybe if you happen to forget, well, I know cost of goods sold is, I know I debit cost of goods sold, what's the credit? Come back over here and you can see, oh yeah, the credit was to inventory. Or what about operating expenses? When I debit, what's the credit? Well, we're doing that on account, so that's going to be an accounts payable, or some sort of payable. Okay? All right, well, good luck. Try to work through February, get as far along as you can. Hopefully you'll get all the way through. And when you're finished or at a stopping point, then we'll watch the video to see how to work it. But again, I want to strongly encourage you, please attempt the MixMax, because if you just watch me work it, you won't learn near as much because you won't be challenged to think on your own. So make sure you've attempted it, then go look at the video.